ConocoPhillips just reported an adjusted earnings per share of $3.24 for the second quarter of 2026,
Right.
which is a massive 9.5 to 13.7% beat depending on which Wall Street tracking model you look at.
Yeah, easily clearing those $2.85 to $2.96 consensus estimates.
Exactly. And GRAP EPS landed right at $3.23. Total revenue and other income hit $19.52 billion, so that comfortably beats estimates that were, ranging from $17.53 to $18.79 billion.
So strictly operating revenue did miss expectations,
Yeah.
but by a razor-thin margin. I mean, a fraction of a percent. It came in at $18.64 billion.
Right, basically a rounding error.
Yeah.
And management reaffirmed full year 2026 capital expenditures of $12.0 to $12.5 billion. They're targeting a 45% return of cash from operations to shareholders, and they guided third quarter production to between 2.29 and 2.32 million barrels of oil equivalent per day.
And the market reacted incredibly well to those numbers.
Oh, absolutely. We saw a pre-market bump up to 1.4%. The stock opened at exactly $120 flat, hit an intraday high of $120.05 on heavy volume, like 8.65 million shares, and eventually settled to close at $116.76. So locking in a solid 1.50% gain for the day.
So they crushed earnings, and the stock jumped.
Right. But here's the absolutely fascinating part. They actually pumped less oil to do it.
Which is entirely counterintuitive.
Yeah.
You'd assume that for an energy giant, pulling less product out of the ground directly translates to lower profits.
Right.
But the exact opposite happened here.
Yeah, if you are a retail investor holding ConocoPhillips right now, or if you're just, tracking the broader energy sector, that math sounds like magic. So our mission for this deep dive is to figure out how management actually pulled this off.
We really need to look at how they're generating so much cash on lower volume.
Exactly. And why they're suddenly selling off American assets while quietly buying in the Middle East. Plus, what this major C-suite shakeup means for the stock's momentum going forward.
Yeah, there's a lot to unpack there.
So let's start with that volume paradox. Because if you look at the income statement, adjusted earnings jumped 128% year over year. They pulled in $4.0 billion this quarter versus just $1.8 billion in Q2 of 2025.
Right.
But overall production went down. So if you're selling less of your core product, how do you manage to more than double your bottom line profit?
The answer lies entirely in the realized margins. What we're seeing here is just the sheer leverage this company has to global commodity pricing.
Okay, how much leverage are we talking?
Well, ConocoPhillips saw their total average realized price surge 36% year over year. They were getting $62.33 per barrel of oil equivalent, which is up from just $45.77 in the second quarter of last year.
Wow, that's a huge jump.
Exactly. When your realized price across a massive global portfolio jumps that drastically, it completely masks the underlying drop in physical production volumes.
Okay, so it's like a premium retailer. Imagine a luxury brand selling fewer handbags this quarter, but because they hiked the markup on every single bag by 36%, they end up posting record profits anyway. It's all about the margin per unit.
That's a great way to think about it.
But, looking at these top-line numbers, I do want to clarify something that might confuse anyone reading the financial press this morning.
Sure.
Because we mentioned the total revenue beat of $19.52 billion, but strictly operating revenue actually missed the target. The target was $18.69 billion, and they came in at $18.64 billion.
Right.
So wait, if total revenue includes things like asset sales or equity earnings, operating revenue is just the physical cash changing hands for the physical oil, right?
Correct. It's the core day-to-day operations.
So if a physical tanker gets caught in a storm in the Atlantic for like 48 hours,
Right.
and it docks on July 1st instead of June 29th, that counts as an operating earnings miss on paper.
That is precisely how the accounting works for exploration and production companies. A tiny delay in pipeline delivery timing, or a tanker held up at a port, pushes the physical recognition of that cash into the completely next quarter.
Wow.
And we are talking about a $50 million discrepancy on an $18.6 billion base. It is literally a rounding error.
Right.
And this is exactly why institutional investors look right past operating revenue misses of this size. They do not care about a 24-hour tanker delay. They care about the cash generated per barrel that actually gets sold.
I do have to push back a little bit on behalf of the retail investor here, though.
Okay, go for it.
If earnings are entirely dependent on commodity prices soaring 36%, aren't you just buying a proxy for the oil commodity itself? I mean, if I hold the stock, I want to reward management for executing a strategy.
Sure, absolutely.
But if they just doubled their profit because global oil prices happen to spike, Aren't they just getting lucky with the macro environment?
That is a really common critique of exploration and production stocks, but it ignores the expense side of the ledger entirely.
Okay, how so?
Yes, macro prices provided a massive tailwind. But think of it this way. What happens if commodity prices rise 36%, but your operating costs rise 40%? Because of, say, supply chain inflation or labor costs and drilling fees.
Well, then your margins stay flat or even shrink. You definitely don't get a 128% jump in profit.
Exactly. Management's execution is found in the cost control. Think of it like a commercial bakery. If the market price of a loaf of bread suddenly doubles, but your rent, your oven electricity, and your flour costs stay exactly the same.
Then all of that extra revenue from the higher bread price falls straight to your bottom line.
Precisely. ConocoPhillips management kept operating costs aggressively flat. They're projecting around $10.2 billion in operating costs for the entire year. So they widened the margin from both ends.
They captured the higher realized prices at the top, and they ruthlessly compressed costs at the bottom.
Exactly. That is not luck. That is operational discipline.
Keeping the oven costs flat while the price of bread doubles.
Okay, that makes perfect sense. So you need the discipline to actually retain the profits when prices spike.
Right.
But let's dig into why they were producing fewer loaves of bread in the first place.
There.
You look at the production numbers, and total production dropped by 143,000 barrels of oil equivalent per day.
And just to ground the acronyms for everyone, when we say MBOE, we mean 1,000 barrels of oil equivalent per day. So production dropped to 2,248 MBOED, 2.25 million barrels a day.
And even if you back out the assets they sold off recently, that is still a 4% organic drop in production.
Right. So where is that drag coming from?
The drag is almost entirely international, and it's a mix of global constraints and scheduled maintenance.
Okay.
First, you have the Middle East conflict, which has created some logistical and operational constraints that directly impacted their liquefied natural gas production out of Qatar.
Got it.
Then you look up in Canada at the Surmont Oil Sands Project, which is a joint venture. They hit a completely different kind of headwind there regarding royalties.
Because Surmont operates on a sliding scale royalty structure, right? How does that actually dent their production numbers?
Well, it directly reduces the net barrels they get to claim. In Canada, this project reached what is called the post-payout phase.
Meaning what exactly?
Basically, the local government says, once you have sold enough oil to completely pay off the billions it costs to build this massive facility, our cut of the profits goes up.
Oh, I see.
Because oil prices are so high right now, and the initial capital costs have been recovered, it triggered a much higher royalty rate. ConocoPhillips is now paying a 40% royalty rate on that Surmont production. Yeah, that takes a massive bite out of the net volumes they get to report.
So they are effectively losing volume to the Canadian government's tax structure.
Yes, on a net reporting basis.
Yeah.
And then when you add in several scheduled maintenance turnarounds, you get that overall 4% drag.
Now, just to clarify turnarounds for a second, is a turnaround just swapping out drill bits, or is this a bigger deal?
Oh, it is a massive deal. A turnaround is a scheduled, complete shutdown of a major processing facility or platform.
Wait, a complete shutdown?
Completely. You stop production entirely for weeks to do deep structural maintenance that keeps the facility safe for the next decade. And they had major turnarounds hit simultaneously in Alaska, Malaysia, and Norway this quarter.
Oh, wow.
Yeah. You zero out production at those facilities for weeks, and that severely impacts the quarterly average.
Okay, so Qatar is constrained, Canada is taking a 40% cut, and Alaska, Malaysia, and Norway were literally shut off for maintenance. I mean, that sounds like a disaster on paper.
It does.
But then you look at the United States, and the lower 48 is just carrying the entire company on its back right now. Production there hit 1,479 MBOED. And the Permian Basin is doing the heavy lifting with peer-leading record-breaking performance.
Unbelievable numbers out of the Permian.
Yeah. The Delaware Basin alone was pumping out 720 MBOD, and the Midland Basin was at 202 MBOED.
The U.S. shale assets are the undeniable anchor of their portfolio right now. I mean, they are running at absolute peak efficiency.
Which brings up a massive contradiction, honestly. If the lower 48 is crushing it with absolute record Permian output, why in the world did they just sell off $1.7 billion in non-core lower 48 assets this quarter?
It seems backwards, I know.
Right. If that is the golden goose, why are you selling pieces of it?
Because in the oil business, not all acreage is created equal. What you are looking at is textbook portfolio optimization. ConocoPhillips had a stated strategic goal to divest $5 billion in assets.
Okay.
By selling off that $1.7 billion in the lower 48 in July, they actually hit that $5 billion target ahead of schedule.
But again, why sell in the exact region where you are breaking records?
Because you do not want your capital tied up in average wells.
Uh-huh.
Look, the Permian is huge, and they own a lot of land there. Some of it is Tier 1, premier acreage that yields incredible amounts of oil very cheaply.
And the good stuff.
Right. But some of it is Tier 2 or Tier 3 acreage. It produces oil, sure, but it costs a bit more, and the wells deplete a bit faster.
Okay, I follow.
By shedding those less efficient non-core assets, they free up capital, drilling rigs, and labor. They stop spending money maintaining average wells and redirect every single dollar to their premier high-yield acreage.
Well, that makes sense.
Yes, shedding those assets shrinks their total production volume slightly, but it absolutely maximizes the profit margin on every single unit they actually pull out of the ground.
Okay, so it's addition by subtraction. You shrink the overall footprint to make the remaining footprint hyper profitable.
Exactly.
And when you optimize a portfolio like that and you combine it with those $62 realized oil margins we talked about earlier, you start generating an almost incomprehensible amount of cash.
The cash generation is staggering. Cash from operations hit $7.2 billion just in this quarter alone.
Unbelievable.
And free cash flow was up 207% year over year, landing at $4.41 billion.
So if I'm holding this stock, I want to know what management is doing with that mountain of cash. Are they hoarding it or are they returning it?
They are definitely returning it.
Yeah, looking at the distributions, they handed out $3.0 billion this quarter.
Yeah.
They doubled their share repurchases to $2.0 billion, and they paid out $1 billion in ordinary dividends, which comes out to 0.84 cents per share.
Right.
And management was very clear that they are perfectly on track for their target to return 45% of their cash from operations to shareholders for the entire year.
And that 45% floor is a critical metric to understand.
Why is that specific number so important?
Well, in the past, energy companies would promise fixed dividend payouts. But oil is incredibly volatile. If the price of oil crashed, the company would have to take on debt just to pay the dividend, which obviously destroys the balance sheet.
Right, that's a death spiral.
Exactly. By committing to a percentage, 45% of cash from operations management gives investors a predictable framework. If oil goes to $100, the shareholder gets a massive windfall. If oil drops to $50, the payout shrinks, but the company's balance sheet remains perfectly safe. It is a highly disciplined approach.
But the cash they are retaining, the other 55%, is where the story gets really interesting. Because we just talked about how they are selling off $1.7 billion in American shale assets to optimize the portfolio. But internationally, they're aggressively buying. They just acquired a 42% stake in a joint venture in the Kirkuk area of Iraq from BP. They signed agreements to increase their liquefied natural gas offtake to 12 million tons per annum, and they're executing an agreement to re-enter Syrian gas fields.
That's right.
I have to play devil's advocate here, though, bringing in some outside analysis. Morningstar explicitly lists a bear case for ConocoPhillips, stating that American shale is actually a high-cost source of supply that might eventually get displaced by lower-cost conventional oil.
It's a valid concern.
So is ConocoPhillips hedging against their own Permian success by suddenly buying into decades-old fields in Iraq and Syria?
It is a brilliant hedge, honestly. When you analyze these moves purely as financial supply chain strategies setting the geopolitics aside, management is directly mitigating the exact risk Morningstar is pointing out.
How does that balance out mechanically?
You have to understand the fundamental mechanics of how different oil fields behave. The Permian Basin is a shale play. Shale is what the industry calls short cycle. When you drill a shale well, you get a massive immediate burst of oil, which is great for quarterly cash flow.
Right.
But the decline curve is incredibly steep. A shale well might lose 60% of its production volume in the first year alone.
It's like the Red Queen effect from Alice in Wonderland. You know, you have to run as fast as you can just to stay in the same place. If you stop drilling new wells constantly, your total production falls off a cliff.
Precisely. It is a capital treadmill. Now, contrast that short-cycle shale with the international assets they're buying into. Kirkuk in Iraq is a conventional reservoir. These are long-life assets.
Meaning they produce slower but longer.
Exactly. Conventional drilling requires a massive amount of upfront infrastructure. But once the pipes are in the ground and the oil is flowing, the decline curve is practically flat. These conventional fields produce at a steady, reliable rate for decades, and the ongoing maintenance costs are incredibly low.
So they are using the massive immediate cash flow from their short-cycle American shale to fund the acquisition of long-life, low-cost international assets.
Exactly. They are building a shock absorber into their supply chain. If the shale treadmill ever gets too expensive to maintain, or if Morningstar is right and shale gets displaced, ConocoPhillips will have decades of cheap conventional oil flowing steadily out of the Middle East and through their global LNG network.
Wow.
It balances the portfolio perfectly between short-term cash bursts and long-term stability.
Which fundamentally changes the financial profile of this company over the next 10 years. And executing a dual strategy like this, squeezing maximum profit out of the Permian while simultaneously expanding into complex conventional fields overseas requires incredibly steady leadership.
Absolutely.
But right as the strategy is hitting its stride, the architect of it is stepping down.
Yes, CEO Ryan Lance announced he is retiring on September 1st, 2026. He has been at the helm for 14 years, guiding them through some incredibly volatile commodity cycles. He is transitioning to an executive chair role, but the day-to-day leadership is officially changing hands.
And the person taking over is Andy O'Brien, who is currently the chief financial officer. Meanwhile, Connie Haynes-Welsh is moving up to take the CFO spot.
Correct.
And I think it's important to frame what this specific transition means. This isn't a turnaround CEO being brought in from the outside to fix a broken, sinking ship. This is handing over the keys to a luxury sports car that is already doing 100 miles an hour on the highway. O'Brien's primary job is just to keep his hand steady on the wheel and not crash it.
Wall Street is reading it the exact same way. When a board of directors promotes the chief financial officer to the CEO role, it sends a very specific signal to institutional investors.
That's a signal.
It says, we are prioritizing financial discipline, free cash flow generation, and returning capital to shareholders above everything else. They are not bringing in some wildcat driller who wants to pursue growth at all costs.
Makes sense.
The market loves that continuity, especially when the current conservative strategy is already throwing off $4.4 billion in quarterly free cash flow.
And the analyst notes reflect that confidence entirely. We are seeing price targets from Morgan Stanley, Barclays, and Wells Fargo ranging from $126 all the way up to $189.
Yeah, it's a wide range, but very bullish.
UBS even raised its price target, specifically citing the company's incredibly strong project pipeline. And when you look at that pipeline, everything is pointing toward one specific date that management keeps hammering on, which is 2029.
2029 is the culmination of every operational move we have discussed today. Outgoing CEO Ryan Lance reaffirmed their goal of hitting a $7 billion free cash flow inflection point by 2029.
An inflection point, meaning a sudden structural shift upward in how much pure cash they generate, separate from the normal fluctuations of oil prices.
Exactly.
How does an oil project magically transition into an inflection point?
It comes down to the mechanics of how capital expenditures, or CapEx, are deployed on massive conventional projects. Right now, ConocoPhillips is spending heavily on a massive development in Alaska called the Willow Project.
Okay.
When you build a project of that scale, it requires immense front-loaded capital. You spend billions of dollars over several years building infrastructure, roads, and processing facilities before you ever sell a single drop of oil.
Right, it's a massive cash drain for years. All money out, zero money in.
Exactly. But by early 2029, the Willow Project is expected to achieve what the industry calls first oil.
First oil.
That is the moment the infrastructure is complete, the valves open, and the commodity actually starts flowing to the market. Once you hit first oil, your capital expenditures structurally decline because the expensive building phase is finally over.
Oh, I see.
Just as your spending drops off a cliff, your revenue from those new barrels spikes. When spending goes down and revenue goes up simultaneously, your free cash flow explodes. That is the structural $7 billion inflection point that Andy O'Brien is being tasked to manage.
So the finance guy is being put in the driver's seat just in time to manage the transition from a heavy investment phase into a massive cash harvesting phase. That makes perfect sense.
It's all connected.
This entire earnings report, the massive EPS beat, keeping the bakery oven costs flat while bread prices doubled, shedding the average Permian assets to focus on the highest yields, the strategic conventional buys in the Middle East. It is all laying the foundational groundwork for that 2029 target.
It really is a masterclass in long-term portfolio management. But, looking at these moves raises a massive existential question for the broader energy market.
What's the question?
Well, if a giant like ConocoPhillips, which already possesses some of the best shale anchorage on the planet, is actively diversifying away from being entirely reliant on the U.S. by locking up long-life conventional assets overseas, what does that say about the future viability of the pure-play American drillers?
Wow. And that is the perfect thought to leave you with today. We started by comparing ConocoPhillips to a premium retailer effortlessly hiking markups, or a sports car cruising at 100 on the highway. But when you factor in Morningstar's bear case regarding high cost American supply and Conoco's aggressive, quiet pivot toward Iraq and Syria, you have to ask a bigger macro question. As we look out to 2026, 2029, and beyond, will the true winners of the energy sector be the pure play American shale drillers? Or will the real spoils go to diversified giants like ConocoPhillips, who are quietly locking down decades old, low cost conventional assets in the Middle East, while everyone else is still entirely focused on Texas? Are we seeing the quiet end of the shale only era? If you want to stay ahead of the markets and unpack the how and why behind the numbers, follow the show for our daily earnings coverage.